In today's video, we're going to continue comparing and contrasting perpetual versus periodic inventory methods in accounting. However, now we're going to look at it from the point of view of sales. The prior videos had looked at the purchase of merchandise to put in an inventory. Now, in today's video, we're going to show you what it looks like for the sale of that merchandise to customers. But first, I want to say I believe something great is going to happen for you today. And now, back to the video. As I mentioned, I have been doing a series on the differences and similarities between the perpetual versus periodic inventory methods. If you have missed that series, the beginning of it is linked up here at the top. Take a look at that after this video. We've reached the point where our company has purchased merchandise. There's been some returns and allowances and cash discounts taken when they've paid the bill. Now that inventory is sitting there ready to sell, and now we're going to sell some of it to a customer. We're going to journalize the following transaction. By the way, if you find accounting confusing, go ahead and give this video a thumbs up, and that way I'll know that you're out there and could use more videos making accounting easy, just like this one. All right, we have a company that sold some of the merchandise that cost the company $300 to a customer on account for $500. So we can see that we sold the merchandise, the customer paid $500 for that merchandise, but it cost our company $300. So in there is that's going to be part going toward the profit of our company. And it was sold on account, so it wasn't sold for cash. So we're going to first look at the perpetual method. Under the perpetual inventory method, we're going to first record the sale. As I mentioned, it's not a cash sale, so the debit is going to be to accounts receivable. And that's going to be for the $500 that the customer is paying for the merchandise. Our credit is going to be to sales revenue. And that's going to be for the full $500. So we've recorded the first part of the transaction, in which we've now recorded the sale and we've booked it to revenue. We now need to also account for the cost of goods sold. So we're going to debit cost of goods sold, and that's for what it cost the company, and that was the $300. So we're going to debit $300, and then we're going to credit the inventory, because the inventory, which is an asset account, is being reduced by $300 worth of merchandise. So this is the perpetual method. We're continually putting things into and taking out of inventory as things are purchased and sold. You have now properly accounted for the sale of merchandise under the perpetual inventory method. Now, let's look at the periodic inventory method. In this case, we're going to use the same exact sale, $500 merchandise, which cost the company $300, but we're going to go ahead and do the sale, which is the accounts receivable. For the $500. And we're going to also book it to sales revenue with a credit. At the time of the sale, we notice that this is exactly the same as the first part of the perpetual inventory method. So you know you're on track when you're doing that. But when you're in the periodic inventory method, you do not calculate the cost of goods sold at this point. That will be done later. So at this point, you're done recording and journalizing the sale of the merchandise under the periodic inventory method. If you find this sort of information helpful, please consider going to my website, askprofessorcapko.com, and signing up for my free newsletter to get updates. Also, down in the description, there's some various ways you can support this channel, but one of the most important things that you can do is to subscribe to this channel and click that notification bell so you never miss a video. Thank you.